Joining me is Alex Morris. He's Chief Investment Officer of FM Investments. Welcome, Alex. It's good to have you back.
Kelly, thanks for having me back.
You know, I'm just joking a little bit. You also own NVIDIA. So it's not like you're, to quote Joe Kernan, sleeping with the light on. But explain to me, I mean, I did see the 10-year, it's up back to sort of the mid-380s. You're on the shorter end of the curve. But does this keep the Fed in play for now?
I think it does. I don't think the Fed was ever out of play. And they'd made that pretty clear. We've priced in 1/4 point. They said get ready for another rise towards the end of the year. And this will give them what they need to do it. But it also urged a little bit of caution. This is one data point subject to revision. We shouldn't get too excited. But I do think it does show that the Fed does need to stay on rates, and they will keep them higher for longer until they have gotten rid of persistent inflation fears.
What's that doing to the price? Let's show the T-bill, the X-bill. These are the 3- and 6-month Treasury ETFs, maybe even the 2-year. What does that do to the price of those ETFs?
Well, if rates go up, price goes down. But that's great news if you're trying to harvest yield, because the yield will continue to be high. Those are all yielding 5% plus, which is a great place to be, particularly if you don't have a strong view on where you want your risk to be, whether it's duration assets or duration itself in bonds or tech stocks. Might as well hang out and clip 5%.
Yeah, I mean, explain to me the investment philosophy behind, I want to own some yield, but I want to own, NVIDIA. Like, what's the kind of overarching philosophy here?
So the play we came into the year with was we wanted to barbell our approach between tech and growth stocks that we thought had been both beaten up and long-term had great long-term earnings opportunities. And the AI revolution that became very personal this year proved that out. The other answer was to stay and take the Fed at its word and stay on the short end of the curve where we felt we had the opportunity to earn yield before we were ready to put all of our chips back into the equity markets or to really start to unwind into longer duration bonds.
Right. So what do you do now? Because that setup, in July is very different than it was in January.
Yeah, the setup's different, but I think the result's probably pretty much the same. AI is not going anywhere. We're still buying lots of iPhones. We're still in that space. It may take a break, but in all fairness, momentum stocks need a breather from time to time, and this is what that breather probably looks like. Not coincidental it's happening during July and August when folks are away from the desk anyway.
It also highlights something that Mike Santoli is always beating the drum about, but the tech stocks can do well in a period of rising rates.
Absolutely. They have in the past. They probably will continue to do so now. And I wouldn't look for that trend to change anytime soon.
So what do you do between now and December then? I mean, as people are kind of now changing their macro calls, lowering their recession odds, maybe, putting one more Fed hike than they otherwise would have back in play.
We still like the short end of the curve, but we increasingly are seeing people take those profits and reinvest in longer duration assets, particularly in some bonds. We've stayed away from high yield bonds. There's the default rates ticking up to 4% are a little worrisome, and we'll stay away from some of that action. But with credit conditions generally tightening, spreads are super tight again, which is good to see. We think there's some real value in adding duration, both in the Treasury market and starting to eke back into the corporate space.
But it's interesting what you said about, so for instance, you look at the S&P today, and of course, we're going to talk about Netflix and we're going to talk about Tesla, but Discover Financial is the worst stock. I think they had a double miss. We're seeing First Ally talking about some worsening underlying trends, now a name like Discover. I mean, you do wonder if credit quality is deteriorating and going to eventually kind of bubble up from maybe these unique or niche companies to something, broadly more of a headwind.
It kind of has to. At some level, we appreciate that not every company is going to always surprise. Some of these companies learned that they could put up pretty aggressive earnings expectations and be rewarded in stock price appreciation. And then they miss, and they get smacked pretty hard for it, which is what the market should do. But the financial sector is usually the most sensitive to interest rates, given that's ultimately their business. There are a lot of bank CFOs, a lot of credit company CFOs looking very tightly at net interest margin numbers, and that's going to be harder to do. So I'm not too worried about some of those starting to falter. I would worry more if we saw a broad set of defaults going across or broad misses across every sector, and we just haven't seen that.
Today is not that day. Alex, thanks for your time. We appreciate it. Alex Morris.